There is a simple pattern that happens all day, every day, in every market, and this simple pattern is probably why you're finding yourself entering trades too early, resulting in break-even trades or even losses. Today, I'm going to explain this pattern in depth, show you a live trade example that we had on our daily live stream, and overall just how you can improve your entry timing so you avoid those pesky break-evens or losses. Make sure to like, comment, and subscribe to automatically enter our giveaway we do every single week. We are giving away a 5K challenge account from Fund Your FX. And with that being said, let's dive into the video. All right, so we have the general concepts of higher highs and higher lows. I know this is boring, but hold on, just bear with me. We have the general concepts of higher highs and higher lows, and we all talk about that, and the lower lows and lower highs, and we all know about that. But let's be real for a second. The market does not move like this. When have you ever seen a chart that just continuously does this other than Amazon stock or Apple stock or one of those? Especially in day trading, you're not going to see straight moves up and straight moves down followed by straight moves up. Okay, what do you get? You get something a little more complex than that usually. What do you get? You get something that looks like this, and then maybe you get something like this. Dun, dun, dun. And then something like this. Whoa, now it's getting confusing. And then finally, maybe something like that. Okay? And even in here, you're going to get something like this, just in smaller waves, blah, blah, blah. Okay? Now, inside all of this choppiness, we have these patterns. And it's not just about the ABCD pattern. It's really just understanding that the market, instead of moving like zigzags, okay, which is the normal way that most people understand, right? Just zigzags. The market doesn't move that way. It moves in W's and M's. Oh, well, that was reverse. M's and W's. Okay, here's your M. Here's your W. Okay, this is going to be a lot more realistic for how the market moves than trying to expect this. Okay, that just doesn't work. So what do I mean by it's going to help you stop entering so early? Well, go back in your charts and you'll see that a lot of the times, instead of getting this, okay, and when you go back and start back testing, okay, and you'll find that let's say you get a higher high and then you got something like this, and now you're looking to buy on the pullback. Okay, so you get your initial move, and then you go, okay, I'm going to buy right here, only for the chart to do something like this, and then you go, okay, I'm going to go to break even, right? Because we're retesting these highs. And then we do this, and then what happens? Get stopped out for break even, something that I'm doing a lot of lately. Hopefully this trade on BitUnex doesn't do that. Let's take a look at that right now. Okay, that's looking okay. It's looking all right. You get stopped out for break even, right? Only for price to do this, and then this. And then you're like, what the hell? What just happened? I got the direction right, but I got stopped out for break even, or maybe even a loss if you tightened your stops or something like that. So what happened was that the market was moving how it always moves, in these W and M's and ABCD patterns, okay? So, and this is not to say that every time you see one of these, you just buy it, okay? Obviously, nothing is like that. It's nothing is magical. So the alternative is, instead of buying on the first pullback, you wait. You sit on your hands. I know it's hard. I know it's so tempting. You see that juicy level of broken resistance or a level of demand, and you just want to buy it all up on the first test. And I'm guilty of doing that as well. But usually the only time that works, the first test, is when there's volatility and it's a very quick pullback. Okay, that's usually when the first test entry method works. Okay, when you get something like this, right? Like the market opens and you go like, and then you go boom, 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 right? This is usually like when the market opens, you'll get a setup like that. But in normal market conditions, what usually happens is the ebbs and flows, the W's and M's, that just stops everybody out and then continues. Okay, this is why I said it sounds almost like ICT concepts of like liquidity sweeps, and it can be used in conjunction with liquidity sweeps. I'm not saying it's not similar, but we can actually measure it. Okay, and the way we measure it is we do something like this. Okay, we have higher high, higher low, higher high. Okay, there we go. This is an actual setup that is pretty nice, that I see over and over again. So what you get is, this is the first pullback, right? And now you're thinking, all right, here's the level of resistance, and maybe there's a little level of demand down there. I'm just going to go ahead and buy as soon as we get down to this level, right? So let's say we get close to that area, you start buying, and then price goes up. And let's say we go up like this. Okay, great. you're in profit, everything's nice, but now price starts dropping again, right? And then you get stopped out for break even or even a small loss. Well, instead of buying here, you wait a couple minutes or hours or whatever it is, and what you do is you look for the ABCD pattern, and all the ABCD pattern is an equivalent move lower. And so what we do is we take this move here, copy paste, and we put it down like this, and we project it forward. Okay, and then price now will come back and break this low, so that's why it's kind of like a liquidity sweep, and usually price will get pretty dang close. It's not going to be perfect, but get pretty dang close to that ABCD pattern. And when you use it with confluence, like a level of demand, for example, that is the better area to buy. You let price shake out the people that are buying on the first dip, okay, because the retail traders get stopped out, right? They're getting stopped out for break even or even a loss, and then you start looking to buy. So it's the second wave, I guess you could call it. Okay, so you have A, B, BV, C, and D. And the D point is where you start looking to buy. And if you take all of this and you flip it upside on its head, that's what happens if you are looking for shorts, okay? It's literally just flipped upside down. It looks like this, right? Boom, boom, copy and paste, boom, boom, and this is your D point right over here. So now this framework, and again, it's not perfect. You're not going to get, I mean, sometimes it is perfect. We've seen on stream just an instant reversal right at the D point. We've seen that. I think we saw that this morning. Time is becoming so diluted for me. But it's not going to be perfect, okay? It's just a framework, okay? And you got to, instead of viewing the markets like this, you want to view the markets like this. And so you don't want to be buying like that. You want to be buying here, okay? Don't want to be buying on the first wave. You want to be buying on the second wave. And that is going to help you out to not enter too early, because trading is really all about your entry. Okay, and people argue about this, but the better your entry, the more likely you are to succeed, because you don't get forced into break-even positions, right? Because if you're entering here, even though it seems like a great entry because it does go up, if you put your stop loss to break even, you're forced to take that break even. Whereas if you're buying down in here, price can do something like this, right? And you're not going to get tagged unless it's just a complete failure, and you do that. Obviously, that also happens. It's not 100% foolproof. Okay. Before I continue, any questions from the 8 people? ICT and those traders have done a great job of just overcomplicating things that have already existed. So what a liquidity sweep is, it's nothing more than breaking lows or highs and failing to stay there. So usually that looks something like this, right? You get a high, and then you get this, and then you get back up to the high, you break it for a little bit, and then you go right back down. Okay, that is a liquidity sweep because there are stop losses above that level. And then if you have a low and you break through that low and then quickly reverse back into the range, that's also a liquidity sweep because there are stop losses below here, right? People buying. Their stop losses go below the low. The idea is that smart money, institutional traders or whatever, the invisible enemy, uses those orders as liquidity because these are going to be sell orders sitting here, okay? And so that is liquidity for people that want to buy. If they want to buy, they need somebody to sell it to them, so they start buying where others are selling. That's the general idea. What time frame do you use for the ABCD pattern? Any time frame. Any time frame works. It works in all charts. So let's take a look at an example. Right now, I mean, we have a trade going on right now that is a perfect example of this, okay? Actually, I couldn't even ask for a more perfect example right now, okay? Let's break it down. So here's the trade over on BitUnix, okay? This is currently the live trade. Now, this could easily take me out for break even. I'm not saying this is a winning trade necessarily, but it's not going to be a losing trade at least. But it follows what we literally just covered, okay? Like, perfectly. By the way, if you want to use BitUnix, it's a no KYC crypto futures broker that has, I mean, it's not like I'm forced to promote them. Like, they are literally one of the best brokers that I've ever used. Their data is amazing, and you also get sign-up bonuses and trade bonuses if you use the link in the description of this stream or video, okay? No pressure, but if you're going to use them, just make sure you use that link because it helps me and you get bonuses, okay? But look at the data. I love the data. I never shut up about the data. The data is so clean. It's so accurate. So let's take a look at this trade. Let's break it down on this is the 3-minute time frame, okay? So like we were talking about, we had this noon-ish afternoon run that we saw yesterday and now today here. Okay, so we became obviously more bullish, okay, because we saw yesterday right here, this was at around 11:30. We got a massive run up until around 3:30, and that's when things started to fizzle out. Okay, right now it's about 3, so it looks like we got 30 minutes left. Maybe we should look to exit this trade. I might actually exit this trade, to be honest, because there's no point in holding this all the way through the afternoon. Let me just exit this trade really quickly. All right, I'm out of that trade. Hello, hold on. Okay, so now we can relax in peace and teach some stuff. All right, so we were bullish after this swing, right? This swing was very bullish, no duh. We broke through all of these highs, broke through these highs, these highs, these highs. Okay, we broke through all those highs and we closed strongly above, right? Strong closes above those highs on the 3-minute time frame. So that was bullish, right? Now, the issue is, if you are just trading pure price action, matter of fact, let's go back to this. If you're trading just the price action, you would look at this, at least if you're trading the way that I do, or trading the understanding of price action the way that I kind of show. So if you take a look at this, you're going to think right away, okay, this is a really bullish move. We have a lot of strong projection. Okay, so if you look at this low here or this high here, compared to this high over here, the distance between these highs is very, very, very big, right? That's what we call projection, and that's in my price action video if you want to go and watch it. Usually when you see a move that has high projection, right, big distance between the previous high and the current high, or if you inverse it, it's the lows. Okay, you can measure both lows to lows, right? This distance right here. But in this case, we have a lot of projection to the upside. Okay, big distance there. So that tells you that this move is very strong. And so when we have a strong move, and the pitch as well, the angle at which we are moving up is very sharp, right? Look at that. It's just straight up. So when you have, increasing projection, a large projection, and a steep pitch, right? Steep move higher. What you expect is a zone 1 pullback or a shallow pullback, okay? A shallow pullback just means roughly in between these Fibonacci retracements. Mostly it's going to happen around the 382, okay? Usually you expect a 382 pullback. Now the issue with this is that, as we'll see, we get to that 382 pretty quickly, okay? And look at this. This is a perfect trap, okay? You might see the 382 being respected and enter immediately right here. And you might do something like this. Let's say you're going to target the highs and, I don't know, make it a 2-to-1 trade. This is just for example's sake, nothing serious. Or maybe something like this, I don't know, okay? Doesn't really matter. The point is, this is going to be too early of an entry. Why? Because we are entering something that looks like this, okay? It's a first touch, first pullback, a first wave. So someone like myself who was watching this did not enter here. Instead, I waited, okay? And that's the trade that we just closed. Waited for one, we have a little bit of an area of support right here, right? A little bit of a demand area. Maybe on the 5-minute might be even better looking. Not really. But it's not the best looking area. It's not the nicest demand level, but it is something compared to where we're at here. But most importantly, what do we see? We see that bounce. See, and now you're thinking, all right, that's looking pretty good, right? Like, you're a genius. You predicted that perfectly. Let me go to a break even because we're coming back up to these highs and, it's looking nice. So we don't need to be in this trade if it comes back down, right? And what inevitably happens, you start curling back down. Now you're in too early, you're in too high. And so what I was doing was looking for something like this. A, B, C, D, down into the area of support. And another way of doing it is using the Fibonacci extension and going like this. You go, it's hard to see it because it's white. 1 second, let me change this. Let me change this to not white. There we go. We can make it black. We're all inclusive here. So let's go from the high. We take the Fibonacci extension. You go from the high to the low, and then to the new lower high. And what that does is that actually gives us our ABCD pattern level. Right down in here where it says 1, that represents an equal move. It's 100% of the previous move, and so it's that line right there. Okay, so that's another way of doing it. Both ways are valid, both ways work. Just the simplest way, obviously, is just going to be drawing a line, copying and pasting it, but it's up to you. It's up to your preference. So that's our ABCD pattern right there. Okay, and now let's watch what happens. Okay, boom, into the ABCD pattern and demand level. Okay, And then we were watching this area. It's also a 50% retracement now, right there, which is fine. It's still in line with the bullish move higher. All right, and where did I get in this? I believe I got in a few candles. 1 second. Still waiting. Okay, we didn't quite. I remember us touching that ABCD pattern. I don't know why it's showing that we didn't. Maybe just missed it. Yeah, I guess we just barely missed it. Either way, like I said, it's not going to be perfect. It's in an area of supply or demand as well. Okay, so that's the idea. You don't want to try to pinpoint exactly what price is going to do. It's never going to do exactly what you want it to do. You want general areas. Okay, so once you start seeing the volume increasing, you're in a level of demand. ABCD pattern down. You're creating that. I mean, look at this. This is like an M formation. All right, and then eventually we got that move lower, and that's where I entered. Okay, it was a pretty scary entry, not gonna lie. But what I did is I went to a smaller time frame, like the 1 minute time frame. Okay, this orange line is the 50% from the absolute low to the absolute high, and this was a little bit of a liquidity sweep, right? So what I saw was that we came back into the area of support, took out these lows, but we also have increasing volume, right? So we have these two candles increasing in volume, a lot of buying pressure stepping in, at least it looks like it. And it looks like we got a liquidity sweep because, again, the volume tells us that there was orders there, right? So that was the entry point right there. And so now, instead of entering up here, right, instead of doing something like this, now at least I was, okay, I was doing something like this. I forget exactly where I entered here, but it was somewhere down in here. Okay, now you can do something like that and target those highs, which we didn't unfortunately get. But check this out, okay? Let's now get out of replay mode. Well, actually, let's just play it forward just so you can see, right? We go all the way up, and we see that we take out these highs. That gives us some bearish signal. That's worrisome. That's why we got out of the trade, because it's also 3 p.m., and we don't want to sit through the trade. But either way, I mean, literally buying in here, no matter where you bought, even if you just put a limit order there, I mean, you got a great entry, and that's why I say that it can help you get better entries. That if you just wait, and you're gonna miss more you're gonna miss trades. Okay, sometimes you're gonna get this move here that just continues straight up, and you're gonna be like, damn, I should have bought there. But if you just wait, be a little more patient, it's worth it. Okay, you'll be in less bad trades. Okay. Is this the current, where are we at currently? Oh my God, of course we got out of the trade and it's doing this. Okay, well, this still proves my point. Let me show you guys something else. Can anybody see what we just did before continuing higher? Okay, well, look at the price action, right? Although the price action was definitely scary here because we weren't able to close above this and we saw an increase in volume. Look at the volume right here, right? Looks like a liquidity sweep. Now, by the way, there's no more liquidity here, so we should be able to get to these highs, okay, technically. So that target would have been perfect, but whatever. We already had a good day today, so we won't get greedy. But does anybody see what happened just before that, right? We had a little bit of bearishness here, but overall, look at this price action, right? That is, again, bullish price action. We have a steep angle, okay? We have that pitch up high, and overall, higher low at that 50%. And by the way, if you enjoyed the lesson, smash that like button, pretty please. It is all I ask. Let me know if you guys are enjoying it. Did all of this make sense? By the way, I asked a question. Nobody answered me. What do we see before this next move here? Can anybody tell me? What do we see right here? I mean, not right there, but right before this, which now, of course, we're going down right after I said we should get to here, but whatever. We'll see the long term if this plays out. What do we see? I'll give you a hint. It starts with an A, and it ends in a D. Anybody? Nobody. ABCD. ABCD. Come on, guys. I'm trying to join in, but I'm driving, bro. It's okay. I'm just kidding, guys. I'm just kidding. I'm just messing with you. Okay, look. Again, it's the exact same scenario. You get a bullish move higher. Okay, well, let me just draw it out again for you guys, right? This is the general idea. You go whoom, 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 whoom. And this is the ABCD pattern, right? Okay, that's what we see right here. Doom, 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 doom. And then if we do this, in fact, we can just go on a 1 minute time frame. And let's just get rid of everything else. Okay, what do we see again? Let's go to replay mode. We got this, up, first touch, down. Or actually, multiple touches. Okay, so we go doom, doom, doom. Is that an ABCD pattern? That might actually be an ABCD pattern right there. Yeah, I mean, basically it is. All right, so look at this. This is actually interesting. We get ABCD pattern, right? And that actually works, right? Like that's a perfect area to buy. Now, obviously, you would have been stopped out for break even probably. But now you have another ABCD pattern forming, and it looks like this. From here to there, copy paste right there. Okay, A, B, C, D. Doom, 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 doom. And now, again, what do you see? Let me just delete that. In fact, let me just actually use the tool to make it more clear. Okay, there's the ABCD pattern. What did we see here as well? Oh, that tool's getting in the way now, actually. We see a liquidity sweep, okay? We see a liquidity sweep, guys. We see clear lows there. We see high volume candle right here after sweeping the lows, and it is an ABCD pattern completion, okay? Like so. And do we have a little bit of other confluence? Yeah, actually we do. We have pretty much all of this area as support, right? And so what happens right from that point on? Will this continue? Who knows? But the point is, you're looking to enter down in here, okay? I mean, you're automatically at an advantage if you just start looking for these multiple waves, right? A, B, C, D patterns, or just looking for this M shape and W shape in general, okay? And then you use concepts like liquidity sweeps and supply and demand and support and resistance with it, okay? You don't just want to buy every ABCD you see. Trust me, that's not going to work, okay? It's not magic. I guess the video's over. Like and subscribe. That was the lesson for today.